Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. Of course, as we kind of get into the week this morning, we're going to talk a little bit about something that Congress may have actually, well, they haven't done it yet, but they may be doing something right. We talk a lot on the show about trying to help people be better savers and give people access to more money. There's a bill in the works that Danny and I will talk about this morning that may do just that. So we'll get into that this morning. So stick around. A couple of things yesterday. Markets just kind of flopped around yesterday, a little bit negative territory, sitting right on support at those moving averages. And again, you know, the bullish technical underpinnings remain in place. The MACD buy signal is still doing fine this morning. Futures are looking to point up fairly sharply this morning. Dow's up about 250 points, NASDAQ up 100 points. And this is just really kind of more of this kind of action we've had in the market. So, you know, a couple of down days like we've had, markets kind of reset a little bit, then you get a little bit more of a rally, then a little bit of a reset. And it's really kind of been this whole type of pattern that we've had here for the last couple of weeks. And again, this is interesting despite all of the, you know, economic turmoil, banking crisis, etc. Markets are typically are actually just kind of doing just fine here. And I know that's a little bit, you know, not logical. You'd think, well, yeah, with all this stuff going on, markets should be down a whole lot more. But again, markets are pricing, as we talked about the other day, markets are kind of just pricing all this stuff in. Interestingly, though, as we talked about last week, and I've got an article coming out on this, that earnings estimates for the S&P 500, so S&P Global, they're the ones that report the earnings estimates for the S&P 500. Those are GAAP-based earnings. And so a little different than what FactSet does, which is FactSet produces operating earnings, which are the earnings without any of the bad stuff. So if you want actual earnings, you know, for the S&P, go look at what S&P produces. They're estimating now, and they just released their estimates for 2024. So they are now estimating by the end of 2024, earnings for the S&P 500 will be back to where they were in January of 2022. Now remember, we got earnings surging in 2021 and really 2020 as well, leading to that peak in earnings in 2022 because of a rapid spike in inflation, which led to pricing power for businesses at a time when we laid off a lot of workers, which reduced our operating costs and created these big profit margins. And we gave people $5 trillion to go spend in the economy, which is what generated the revenue for those earnings. Now, the interesting thing is how are we going to get back to that record level of revenues if you've got declining inflation, slower economic growth, and no liquidity? So just something to kind of think about here, because optimism is certainly beginning to return to the markets in terms of Wall Street analysts. Economists also getting a little bit more optimistic now by predicting that this year's economic growth will improve as well. So now economists are starting to ratchet up economic growth expectations as well, with only one negative quarter of growth this year. And they're expecting that the second quarter this year will have negative growth and we're back into positive territory. But if we take a look at a lot of the economic data, it's already starting to improve here a bit as well. So we may not even get that one negative quarter. Again, this is all fairly, consternating when you consider the Fed's hiking rates aggressively, and we're talking about, and of course a lot of the headlines and a lot of the media talk is about, the economic devastation that's coming around the corner. Yet things are holding into place here, and this is why it's always so very important, as we've talked about before, is when you listen to headlines, and particularly in a lot of the media, that's to get your attention, right? So a lot of the stuff that's put out there in videos and YouTube channels and all this stuff, it's massively doom and gloom right now. The economy's going to end and the dollar's going to zero and all this type of stuff. And that's great for getting people to click on links and click on headlines and do those type of things. But we've all got to kind of set that aside and say, okay, that's one view. What is the opposing view and what is reality? And try to figure out what the reality of all the situation is. And look, I don't have the answers, so don't expect me to tell you, it's like, okay, all these people are wrong. I'm the only one that knows what's going to happen in the market. I don't. But this is why we spend so much time talking about technicals in the short term, because look, all the stuff that's related to the economy, and again, if you believe the economy's about to wind up into the deepest recession since the Great Depression, or if you believe the economy's about to explode in growth for one reason or the other, nothing wrong with that view. I'm not saying there's anything wrong with any one of those views, but those things take time to play out. And the problem is by making a bet today about some future event, if that event doesn't occur, it could impede the growth of your portfolio and hurt you financially. So, it's okay to have these longer term views, but remember, these are longer term views. And in the short term, the only thing that matters is what the market's doing, right? It only matters what the 5 million people or 10 million people or however many people are out there that are investing in the markets are doing at one singular moment in time, right? And what is moving prices. Because remember, for every buyer, there has to be a seller. And the only difference in the markets and what makes prices go up and down is just the price at which that buyer and seller agree to transact. So as a good example, yesterday markets were down a little bit, right? All that means is that somebody sold Apple and somebody bought Apple, and the seller just agreed to sell it at a little bit lower price than where it was selling yesterday. But it is still the same number of shares. It is still the same dollars transacted. This is the problem with the money on the sidelines scenario, right? There's this myth of all this money sitting on the sidelines. There's $5.2 trillion of money sitting in money markets right now. And that's just waiting to come flooding back into the markets. And when that money comes back in, man, these markets are just going to explode. Not really. Because again, like a football team, I can have 50 players on the sideline of a football field, right? But I can only have 11 players on the field at a time. And so if I put one more player on the field, I've got to take one off. So there's never more than 11 players for each team on the field at one time. So it doesn't matter how many times that I put players on the field or take players off the field, there's always 11 players. Same thing for the market. So all this money that's sitting on the sidelines only moves the markets because if the money comes in from money market funds, somebody's got to be selling going back to money market funds because you have to have a buyer and a seller. And the only thing that will matter ultimately is the price. Now, also the other problem with this money on the sideline myth is that the vast majority of that money is corporate cash. That cash is used for mergers and acquisitions, payroll, those type of things. It's never meant for investing anyway, and that's the vast majority of that money. So again, yes, some of that money is sitting in money markets. We have money sitting in money markets right now, and when the market improves, we will take that money out of the money market and we will put it back into the stock market, and we'll buy equities from people willing to sell at whatever price that is. Hopefully we'll be buying at the right price and our prices will eventually rise. That's the whole purpose of investing. But this myth that there's all this money on the sidelines is just going to come running back into the markets, and we're going to have another massive bull market. That's not really true. And I've got some charts out this morning on Twitter. Actually, that money market balance has been increasing since 1974. So it's just a function of the economy. All right, quick break. We'll come back. We will pick up with Danny Ratliff. We'll talk a little bit about this bill that Congress is working on and why it may be just a very good thing for you. Wouldn't that be nice to have something good come out of Congress for a change? We'll talk about that when we come back from the break. I'm your host, Lance Roberts. Don't go away.
Daily investment news you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
Long-term care may sound like a bore, but if you neglect it, you'll pay even more. Join Danny Ratliff and Richard Rosso for our next Candid Coffee. Don't be foolish about long-term care. Saturday, April 1st. You may think you're prepared for long-term care, but you may be fooling yourself. Learn how to plan to protect yourself and your loved ones. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. Saturday, April 1st. Realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It's Wednesday, Sunday edition. That means Danny Ratliff is here. As always, Danny, how are you?
Hey, doing great. Thank you.
Good. So, you and I have spent, a lot of time in the past talking about, some of the best ways to save money, particularly for individuals that have access to health savings accounts. That is one of those few triple tax benefits that you can get. And you're a big fan of HSAs.
I'm a huge fan.
Huge fan. Problem is that not that many people have access to them because
That's right.
you have to have a high deductible insurance plan, et cetera, right?
No, that is a problem. And so we are seeing that more and more employers are beginning to offer this because of they're passing on the expenses to the employees. So as more people have access to the health savings accounts, this is a great bill, I think.
Yeah, well, hold on. Before we get to the bill, let's back this up just a sec, because when we're talking about HSAs, they're not that widely adopted because a lot of people just don't know about them.
Or I think they're used incorrectly.
Correct.
I think is a bigger problem.
So how does, so first of all, just real quick, what's an HSA? Let's just start from the basics for everybody. Yep. What's an HSA and how do I know if I have access to one?
So typically your employer is going to give you access to that if you are in a high deductible health plan. Now the issue is that that's not always the case. So you need to go in and do a little bit of homework, especially as you're seeing. I visited with somebody yesterday. They had their enrollment was right now. Now historically that's usually around October, usually fourth quarter. But you may have access to this right now and not even know it. The other caveat here, Lance, is that many people use HSAs like an FSA, a flexible spending account. So the HSA, you actually don't have to roll the funds over. So if you have access to this through your employer, it's likely going to be through your benefits as you're logging in. You'll be able to see all the information there. Use these accounts in a much different way than a flexible spending account. We want these funds to grow. You want to put these funds aside and use this for retirement. So as you mentioned earlier, this is the only account in the world that has that triple tax benefit. Funds go in tax-free, they grow tax-free, and then as you pull them out for medical expenses, you're going to be able to utilize these funds and distribute them tax-free as well.
Right.
So,
and so like with an FSA, you have to use those funds by the
use it or lose it.
Yeah. And HSAs, you never lose it. So it can accumulate over time. They're invested in the markets, whatever you invested in, and they'll grow over time. And then you can as you have and so the whole and by the way, just the reason for the HSA and the reason it's tied to a high deductible plan is, let's say that, again, as Danny says, employers are going, I can't afford healthcare insurance coverage, it's just too expensive. So we're going to pass more and more cost over to the employee. And so one way to reduce that healthcare benefit is to offer a high deductible plan. So in other words, you may have a $2,500 or a $5,000 medical bill to meet first before insurance kicks in. And so the goal of the HSA is you contribute funds to HSA. Those funds are sitting there. So now something happens and you go to the hospital and they go, okay, well, your bill is going to be 10 grand. You take 5,000 from your HSA, pay your deductible, and then insurance pays the rest of it. So that's the reason for the HSA, and this is why it's a good thing. But again, a lot of people don't have access to these. And so this bill, Representative Chip Roy from Texas has introduced a bill that would make tax-free health savings accounts available to all Americans. And again, currently most Americans can't use HSAs due to the stringent rules. And this bill called the Healthcare Freedom Act would change those rules and allow all Americans to have access to these, which I think is a great thing. If we can,
I think it's fantastic.
Yeah, the problem is we can't get people to save money to start with.
That's right.
So we can look at the stats and know that. But this is one of those opportunities that would allow people to save money, put it away, use it for medical benefits, offset some of their medical costs, et cetera.
Yeah, I think the idea, though, is that you need to use this correctly. You need to put the funds aside. So ideally, what I encourage most people to do is that, okay, if you're going to invest the funds, and if you have one of these accounts, please try to pay medical expenses out of pocket. I know it's not always possible, but if you can, and you have the cash flow to do so, go ahead and fully fund this account. Put these funds aside. You can put up to $3,650 currently per individual. So if you have a family, you can put up to $7,300 into the account. So what this bill is actually doing is going to increase that amount. So number one, allow everyone access to an HSA, which will be great. Number two, it's going to raise that from $3,650 to $12,000. So if you have a family or you're married, you'll then be able to put up to $24,000 into this type of an account. Now, I'm holding my breath on this one, or maybe I shouldn't, because as we're continuing to hear more and more proposals about increasing taxes, this is one that would actually be a benefit and help people eliminate it. But with the rising cost of healthcare, I think this is something that maybe can get some bipartisan push behind it.
Yeah. And again, this, there's an interesting, and you just mentioned this. There's an interesting benefit to high deductible healthcare plans. A lot of people hate them because it's like, oh man, I've got to come out of pocket for $3,000 or whatever my deductible is, and it's kind of an onerous bill, and I don't disagree with that. But the reason that insurance costs are so high is because of $25 copays and very low deductibles. And so every time somebody gets sick, they come down with the common cold or whatever, they run to the emergency room, they run to the doctor's visits, et cetera. And so the cost of utilization causes the cost of insurance to go up. The benefit of high deductible plans is like auto insurance in a lot of ways. You pay for the maintenance on your car, right? You pay for the oil changes, you pay for the tire rotations and new tires and the maintenance and the upkeep. And then when you get into an accident, that's when your insurance kicks in and pays for the cost of recovery from the accident. But that's why your insurance premiums are so low for autos, is because it's only for catastrophic use. You do the maintenance. So one of the benefits, and again, Danny just mentioned this,
is the beautiful thing about HSAs is it changes psychological behavior a bit, because now you have this pile of money over here that's growing tax-free that you put in tax-free, and people don't want to touch it, so they start paying out of pocket for the maintenance, right? I get sick, I pay for that out of pocket. It's $200, whatever it is, I just pay for that and go, and I don't touch that. And one of the benefits of giving everybody access to this HSA, if you could change the behavior through this, it would start lowering the cost of actual insurance itself.
Yeah, I think there's a lot of benefits to this. And we actually encourage, so number one, you want to be able to put some funds into cash. So even if you can't invest this, save some funds. So if you're out of work, you do have to go and reach somewhere else to make healthcare premiums. This is an ideal place to be able to utilize. But I would prefer you have a savings account, you have your financial vulnerability cushion, then you have your HSA if necessary. Now, ideally, we want to use those funds later in life in retirement because we know the cost. I mean, the cost for a 65-year-old couple from Health Use Services has gone from $300,000 over your lifetime in healthcare expenses to getting closer to $4 million. Yeah. I mean, these numbers are astronomical. And so we want to make sure that you're utilizing them properly. So I typically would encourage someone to put 2 years of premiums in cash. Then from there, begin to invest. And I think this is one of those accounts, like you mentioned earlier. Many people don't use it properly. They're putting funds into it. Then they're turning around and taking them right out. So you're not really getting the full benefit of what you could see. But this would also reduce your taxable income if you can put these funds aside. And then allowing people to put more, I think, is great. So there's other times, Lance, that we actually will tell people, hey, okay, if we're looking at the hierarchy of savings, we're putting funds aside, we may want to go to the 401k if we're not maxing everything out, get the match, and then are you getting a match in the HSA? Go ahead and then max that out because that's the account that's getting that triple tax benefit.
Right.
Then go back to the 401k.
Yeah. And and this, and again, this also takes us back to the bigger conversation of just getting people to save money.
Yeah.
One of the biggest pushbacks I get from individuals, I get emails every day is like, I want to build wealth and I want to, save for, whatever. And that's great. And so as soon as I start asking a couple of questions, I go, well, are you fully funding your 401k? Well, I can't afford that, right? I can't save that much money out of my paycheck. And I'm like, okay, well, that's the first step. We got to work on the budget at home. And it's great, right? I can put $22,000 into my 401k. What's the limit this year for 23?
Oh, geez.
22,000, 23. Yeah, anyway. So this long day, it's already 6 o'clock in the morning. Anyway, I can put 24,000 into my,
it's 19,000 plus an additional 6,500, I believe.
For catch up. Okay. Yeah. So and see, I'm over 55. So there you go. I can put that money in my 401k, then I can put potentially 12,000 in my HSA. Then I need to save some money into my investment after tax account. And again, just getting people to fully fund their 401k is a challenge. And again, we know this by simply looking at the 401k analysis that come out from like Fidelity and Vanguard every year about, the contribution limits to 401k plans, the average balances. And then you just look at the number of companies that actually offer 401k plans. Only about 25% of Americans actually even contribute to a 401k plan. So I think one of the big challenges we have on top of all this with healthcare and healthcare savings is just getting people to save money, period. That's the one thing we've got to work on.
No, it is. And many people aren't even maxing the 401ks out. So I misspoke earlier. It's 22,500.
Yeah.
But so you do have a lot more bandwidth this. They're continuing to increase this for inflationary pressures. And so this is something, though, that if they raise this bill, I think this will be a really nice kind of another tool in the tool chest.
Yeah. So I'd love to see it. I hope it can get some traction. And this is something, too, that should not be partisan. Right. This should be a very bipartisan effort on getting this bill passed because this benefits everybody. It doesn't matter what side of the political spectrum you're on. It'll be a benefit.
It does. I'm just, a little bit leery of it in the sense that, if they're trying to raise taxes, everything that we continue to hear is that, we need to tax more people. Government needs money. I don't see them real inclined to give us an additional benefit to reduce our taxable income.
Right. Well,
unfortunately,
there's that.
Yeah.
Speaking of getting more taxes, when we come back from the break, we'll talk about what's going on with not 401k plans.
Social Security.
Social Security. Thank you.
We'll talk about what's happening with Social Security as they're running it. And I had an interesting conversation with my son yesterday. He's in from the UK right now. And had an interesting conversation with him because we're talking about filing taxes and Social Security and those type of things. And it was interesting, his take on it. And we'll talk about that as well when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Long-term care may sound like a bore, but if you neglect it, you'll pay even more. Join Danny Ratliff and Richard Rosso for our next Candid Coffee. Don't be foolish about long-term care. Saturday, April 1st. You may think you're prepared for long-term care, but you may be fooling yourself. Learn how to plan to protect yourself and your loved ones. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. Saturday, April 1st. Realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Who needs to send stuff overnight? That's stupid. Put stuff in the envelope, you give it to the mailbox, it gets there in a couple of days, whatever. It's fine. You don't need to get stuff there literally overnight. I mean, who needs to have stuff that quick?
The Real Investment Show podcast. Same show, your schedule.
I'm waiting for Amazon Prime to start becoming pre-Prime, which is, I just want to be able to think about it and then it shows up.
At realinvestmentadvice.com.
And bill somebody else for it.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. I'm your host, Lance Roberts. Danny Ratliff joining me. Social Security, always one of the big hot debate topics because, every year we get the reports from the Social Security Administration Board basically saying that by such and such a date, they're going to have to cut benefits because of, lack of money. And this is part and parcel of what is an inevitable problem that they're going to have, is because back in the 30s when Social Security was founded, we had 16 workers paying in for every worker taking out. In the 50s and the 60s and the 70s and the 80s and the 90s, we keep adding more and more people to the rolls. Everybody from widows to orphans to firemen to, this group and that group and whoever's disadvantaged, wives, etc. We keep adding more people to the social welfare roll at the same time that we have fewer and fewer people continuing to pay in. Today, we have less than 2 people paying in for every person taking out of Social Security. So, one of the inevitable problems is that there's simply just not enough money there, right? It's the pension problem. And, so every year we get a lot of talk from politicians about, well, we need to do things to fix Social Security so we can make it a viable, long-term, funded, solvent entity so that, as Rich says, there's not people lined up in the middle of the street, because there is a tremendous number of people in the country that are dependent solely on Social Security for their retirement income. And that's a sad state of affairs, but that's the way it is. So, there are lots of proposals. Nobody wants to tackle the challenge because it's politically unelectable. So it kind of gets kicked down the road. But, there's a lot of talk every year about needing to raise taxes to increase more revenue to pay for Social Security. And as Danny said a second ago, when we were talking about HSAs, one of the pushbacks on the bill may be is like, hey, we're giving people an ability to pay less taxes when we actually need more taxes for the government.
Yeah, and I think this is a significant problem. And this bill right here is not going to actually fix any of that. None of it. And I don't suspect we're going to see something here, that actually is going to have some teeth to it for a while. And it's unfortunate because they will kick the can down the road, especially if you look at what's going on in France right now.
Right.
I mean, they're rioting in the streets because they raised the retirement age.
Right.
And that's something that will likely have to happen here. And it's unfortunate. But what this bill actually goes out and addresses, so Representative Glenn Grothman out of Wisconsin came up with a bill. It's H.R. 6925, which is very important for all of you. Remember this, okay? I'm kidding.
There would be a quiz at the end of the show.
Yeah, exactly. But they're actually looking to raise the retirement earnings threshold. So currently, here's the problem. A lot of people are retiring earlier. And so everybody says, when are you going to retire? Oh, I'm going to retire at 65. What we find is that actual retirement age is close to 62. Yeah. And so a lot of people are dependent on Social Security, so they need it. They have to take it. But here's the issue is that if you make too much money, there's a retirement earnings threshold. They will actually withhold benefits, your Social Security benefits from you until you reach full retirement age. So they're trying to discourage you from taking Social Security early. So if you make more currently right now and you're under full retirement age, every $2 over $21,240, you're going to have $1 in benefit withheld. So I know people, Lance, who've retired early, didn't actually need the money, but emotionally talk to the neighbors or you see the headline news and say, oh my gosh, Social Security is going away. I'm getting every dollar I can from them. I'm starting it now. And listen, there are times that I can make that argument. Maybe you should start it early. You just have to need it for cash flow. Your longevity is not very long. Maybe you don't have a spouse that's going to be dependent on this. So, Social Security, there are some moving parts as far as how you should take this. But if you're taking it early and you make too much, or you're pulling too much from a retirement account, you're going to have benefits withheld. And in that example earlier, I had somebody who took it and it was on emotional. They had to pay every dollar back that first year. Then Social Security decided they're going to withhold the benefits because the income was going to continue to be higher. And essentially, you're going to get a bump when you reach full retirement age and start getting those benefits back. But now you've locked in a discount. So what this bill is looking to address is to raise it from $21,240 to $30,000, because what we're seeing in this environment, many people, because of the pandemic, retired early. A lot of times we see it because of health issues, and sometimes not even your own, but it's a loved one. So you look at the baby boomer generation, you call it the sandwich generation. Mm-hmm. You've got parents you're taking care of, you have kids you're taking care of. And so a lot of times people are retiring early because of necessity, just to help, in the home. So this would raise this from $21,240 to $30,000, which I think would be nice because we are seeing more and more people going back to work. I have a lot of clients, Lance, that have decided to go back to work doing something they enjoy. They're not making a lot of money, but it's something that keeps them active. Mm-hmm. It's something they learn a new trade or new skill, or they're just out in their social. Right. So I think this would help people in that environment. However, I mean, it's still $30,000. You're not getting real far on that these days.
Right, exactly. But again, this is why it's so important that, when you're doing your financial planning, and this is something that Danny and Rich and John Penn and Jonathan McCarty do exceptionally well, at our firm, is really analyzing the impact of these decisions, right? Do you retire at 62, 65, 67? Never, according to Danny, in regards to me.
Well, yeah, I mean, you're not even eligible for Social Security. You didn't know this?
Yeah, I've never paid into it. Anyway, but this can make a big difference. I mean, you can be literally leaving hundreds of thousands of dollars on the table by making a emotionally driven decision because of market or economic or news headlines, right? And so it's
and we do see that often. So when we're doing, especially for a couple, you do find that this is a decision, a joint decision, number one. So especially if you have the breadwinner and they go ahead and take it early, well, and maybe you have somebody who stayed home and worked in the household, you're locking in a significant discount long term. So you're going to be getting a lot less money. And we do find many times it is hundreds of thousands of dollars over your lifetime looking at cost of living adjustments. It's significant. Yeah. And so taking Social Security properly is a great win for your financial plan, because it takes that burden off variable assets, right? I mean, most people have Social Security, the 401k. If you've done a really good job, you have other assets in other places. But the majority of America, their savings is in their home and in a 401k.
Right.
And so if you're pulling from that 401k, that's all taxable income. And so that's where we have to be really, really cautious if you're retiring early. And, long term, getting more and more out of Social Security. Look, it's an annuity. It's a pension. Mm-hmm. And so it's one you can't outlive. I certainly make sure you take this properly.
Yeah, exactly. So having said that, there you go. All you need to know about Social Security in one morning.
In 4 minutes.
Yeah, exactly. So, one of the things is that, your point, sorry?
Awkward pause.
Oh.
Just tease the
that's right.
Candid Coffee we have on Saturday.
Speaking of Social Security, I forgot about that.
Well, this was not Social Security driven, but
right,
we are
but
doing.
It's part of that retirement thing, though.
Yeah, this is a big part. Is so talking about how people are saving, where they're putting funds, and this is another one where usually people come to us and say, "I need long-term care," and it's usually because they're taking care of their parents who actually need long-term care or have it. And they say, "Wow, I didn't understand the cost, and I don't think I saved properly for this." And so we're going to be discussing long-term care. How to utilize it if it's necessary. I mean, we visit with a lot of people that are self-insured that still choose to go out and look at exploring the options of long-term care, just to try to create some type of legacy as well, so you're not so dependent on your assets. And so we're going to talk about that this Saturday, April 1st at 8 a.m. And go sign up, realinvestmentadvice.com. We'll be taking questions. We're going to cover just a lot of broad information on long-term care. A lot of misconceptions. I think a lot of people think, Lance, that Medicare covers long-term care, right, and it does not. And so we're going to talk about what exactly you can count on and what you can't.
Exactly. And are you going to wear the dunce cap?
Evidently, I did not approve that graphic.
I think you should.
Yeah.
But yeah, no, long-term care is kind of an interesting thing. And when should somebody actually start actively looking at, buying long-term care? I mean, how old do you do this in your 40s, your 50s?
Yeah, I mean, ideally in your 50s, I think, but you could do this in your 40s. I mean, a lot of these plans won't even allow until you're 40 years of age to actually go out and purchase one. And we're seeing it that there's more and more flexibility here as the last couple of years. And so the problem with long-term care is that, a lot of people know somebody that has a policy. And if you bought it back in the 80s and 90s, the actuaries got it way wrong. And so traditional long-term care, you've seen that the cost has gone up exponentially for these individuals. So take somebody who is maybe paying, 30, 40, 50 bucks a month for traditional long-term care. Yeah. And now they're paying hundreds of dollars. This is a big part of their income that they have coming in as far as from an expense perspective. And they're closer to needing it, but they can't afford it. They've been priced out because these companies have gone in and continuously increased the cost of it. So we do look and utilize traditional long-term care from time to time, but there's a lot more, I think, activity around these hybrid policies where they have a return of premium potentially, or you pay a specific amount and then you're not paying any more. Mm-hmm. And so we're seeing a lot more people utilize those types of policies for long-term care. And so I think that's where the industry's going, because what you're paying for and what you're going to get out of it. Some of them actually even have they're kind of life insurance policy that have a long-term care rider, more or less. And so as the industry continues to evolve, we're constantly doing so as well, making sure we're utilizing that and addressing it properly within the financial plan. But many people don't do it until 60, 65. And many times it's because at that age, they're taking care of loved ones who are using it. And they say, shoot, I need to do this. I didn't address it earlier. The problem is the longer you wait, the more expensive it gets. And the less likely you're going to be able to actually, get through underwriting, right? Because now you're more likely to have some type of pre-existing condition.
Exactly. I'm just planning to go quick, painlessly, and quietly.
Yeah, okay.
Tomorrow. Have you ever seen the movie This Is 40? Yeah. So the husband and wife, they're married, and she's turning 40, and it's a big deal. And so they're talking about, have you ever thought about killing me? And they tell each other how they're going to kill each other off. Anyway, be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Long-term care may sound like a bore, but if you neglect it, you'll pay even more. Join Danny Ratliff and Richard Rosso for our next Candid Coffee. Don't be foolish about long-term care. Saturday, April 1st. You may think you're prepared for long-term care, but you may be fooling yourself. Learn how to plan to protect yourself and your loved ones. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. Saturday, April 1st. Realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So I said I'd tell you a little story about this conversation I had with my son, because we're talking about healthcare this morning and Social Security and, this type of stuff. And, I hear a lot of, commentary on the media and stuff, and a lot of misconceptions about the cost of healthcare in the U.S. And, it's so expensive here and it's so cheap everywhere else. And there's big differences. And so I was having this conversation with my son. So my son, I've told you the story before, he moved to Germany, was there working for a while. He's now moved to the UK, and he's going to college there to get his mechanical engineering degree. And so we were talking about he's home right now. We're working on the student visa part. So we're working on this kind of legal stuff. So he's got to be here for a couple of months while we get his visa ironed out. And he needed to go to the doctor and just get a checkup, nothing serious. And so, it was, I called the doctor and said, hey, need to get him in. He's like, okay, tomorrow, 2:00, come in, done. He's like, you got an appointment for tomorrow? And it's like, yeah, that's the way it works here. And he's like, well, yeah, because, it takes several weeks to get an appointment, in Germany. And then in the UK, it's the same way. And so this kind of sparked this conversation about the misconceptions of healthcare in countries. in different countries. And I've lived all over the world, so I've been through this as well. And in most countries, there's two separate healthcare systems. There is the public healthcare system that you pay for through your taxes. Then there's the private healthcare system if you want good healthcare. And if you want really good healthcare, you come to the U.S. So, it's an interesting, and again, there's a lot of this talk around the country about, especially from the kind of the millennial generation, is the, cost of healthcare. And look, the cost of healthcare in the U.S. is expensive. I am not arguing that point at all. However, it's not as expensive as you think when you start talking about quality of healthcare and also how it's paid for. And so this is where my son got into this conversation, and I go, okay, well, let's talk about the differences, because he's like, oh, healthcare in the UK is the best because it's all free. And I go, well, is it really free? How do you pay for it? And he's like, well, it just all comes out of my paycheck. And so when I get my paycheck, I don't have to pay for healthcare. It's already paid for. And I go, yeah, that's true. I said, let's talk about your taxes. I said, how much money do you make? And he, so we went through what his tax base would be here in the United States. And it turns out that he pays substantially more in taxes by a large amount in the UK. But it's even more egregious than that. And this is where people really have a big misunderstanding about things between the US and other countries. If you make $30,000 a year in the US, you're in the top 1% of income earners worldwide. So put that in your hat for a second and think about that. We talk about wealth inequality and all this, but $30,000 in the U.S., 1% of top 1% of income earners worldwide. So my son's going to school to get some mechanical engineering degree. And I said, okay, well, let's talk about this, right? And so as part of this, I said, if you came to the United States, and yes, I will give you that our healthcare cost is higher in the United States. And so I pulled up Glassdoor on the interweb. And I said, let's plug in what a mechanical engineer would make, the salary range for a mechanical engineer in the U.S. according to Glassdoor. Now, again, I'm not saying and I don't email me if you're a mechanical engineer and say, well, I make this. Okay, I'm just going by Glassdoor. Okay, so I needed a factual example, just not stuff I'm making up. And he says, so I go to Glassdoor and I pull it up and I say, mechanical engineer salary range in the U.S., $57,000 to $110,000 a year. And he was like, wow, that's pretty good. I go, yeah. I said, well, let's look at what you're going to make in the UK once you get your mechanical engineering degree, according to Glassdoor. $42,000 to $72,000 for the same degree in the UK. So a substantial discount of what you're earning here, and you're paying more in taxes for lower quality healthcare. So light kind of starts to go off here a little bit. I'm not convincing him to move back to the U.S., by the way. He's going to live in the UK. But, he's starting to understand the differential. But there's more. There's more. I said, it's not just that, Cole. I said, here's the thing, is that the differential in the salaries is actually even greater because the exchange rate of the pound to the dollar is 20 cents lower. It's 81 cents to the dollar. So you're actually even making less money than even what the salary range says, and you're paying higher taxes for lower quality healthcare. So the point about this is that, yes, do we have higher healthcare costs in the U.S.? Absolutely. Nobody's arguing that fact. Do we have problems with the healthcare system in the U.S.? Absolutely. Nobody's arguing that fact. Can we fix those problems? Absolutely. Right? We talked about one earlier. Health savings accounts would help solve that problem.
Well, but that still puts the onus on the individual.
Right. But
which I prefer, but many don't.
Correct. But insurance companies, look, insurance company costs go up. It's supply and demand.
Yeah.
Right? More people demand a service, somebody's got to pay for it, right?
Correct.
And one of the misconceptions is that we've got 20 million people in America that are uninsured and they can't get quality health care. That is a complete falsehood, because they can go to any hospital any day, they get paid for, and guess why your insurance costs are higher is because you've got to pay for those that get free health care. Everybody gets taken care of. But the point is that you make a tremendous amount more money in the U.S. than in other countries for exactly the same type of work. So this was an interesting conversation to have with him. And again, it's just, this what we often forget in conversations when we're having conversations about economics or politics or anything else that we're having conversations about is the huge differentials between populations, right? There's a lot of people that come out and say, well, in Norway or in Finland, they have this. They also have a population of about 6 million people versus 330 million people, right? So, when you start talking about these things, you have to work things on a comparative basis always and work from a fact, work into your arguments backwards on facts, right? Because again, it's always the emotional arguments and we kind of, gloss over the important things, but the important thing for him is that he's going to college to get this degree, to have a job that is going to pay substantially less than what he could make elsewhere in the world. And to him, that's fine because he's not driven by money. It's more of an achievement thing that he wants to do. And that's fine. I remember being that young as well. I didn't care about money then either until I had kids and wife and houses and bills and more kids, then money starts to matter. But he's at that phase in life where it's all about the experience, which is fantastic. And I'm all for it, because again, I spent the first, 15 years of my life traveling around the world, got tons of experience, loved it, experiences I'll never have again, but well worth it. So I'm applauding it, supporting it, but I want him to go fully prepared fact-wise into what he's doing.
Well, I think it's good to be able to kind of have that side-by-side comparison. So what if he wants to come back to the States? So is the quality of education as good? I mean, why are they paying so much less for the same job, right?
Yeah. I don't have that answer.
Okay.
I'll have to look it up.
Well, but can he go get educated there, come back here?
And do the same job? No, I'm sure the certifications are probably different.
Yeah.
So it probably doesn't transfer readily over. I'm sure there's some of it that will. I'm sure I'll probably get an email now. I was like, oh yeah, I got educated in the UK and came to the US and worked. And maybe that's the case. I don't know.
Well, I know people that get educated over there all the time and come here to work, but I just wonder what are the hurdles he may have to overcome?
Right. If he wants to come home and do that same job.
Yeah.
Yeah. I don't know. We haven't got that far into the conversation yet. So,
hey, at least you got him to sit down and have that conversation. That's probably pretty good.
Yeah.
Like, okay, Dad.
It's interesting. No. It's interesting because I've got he's older, right? And so there's this very interesting phase you go through with kids, and anybody has kids at this age, they're going to go, "Yep, been there." Kids are awesome between the ages of 0 and 10.
Yeah, that's right.
They are awesome kids. You get to play with them, Legos, you name it. I love kids 0 to 10. 10, 11, somewhere in there to about 19.
About 9. My 9-year-old is
They're
about 19.
They are a pain in the ass. They know everything, right? My daughter, every time I say something to my daughter, I know, right? She knows everything. Everything she knows. She is the smartest person. If you want to know anything, ask my daughter because she will know the answer.
Yeah.
And then they turn 20 and then they start to realize they don't know everything and you actually have really good conversations with them. I love my 22-year-old because he is awesome. We can have great conversations and because he does live overseas now and has lived in Germany and the UK and other areas where I've also lived.
Probably has a little bit different perspectives.
He has a very different perspective. And we can have very, very good conversations about things. And so because he has a very different because he's also seeing all this political nonsense that we have in the U.S. from their lens. And he's like, y'all are stupid. But, it is a very interesting perspective. But once you can get past that teenage span where they know everything, it actually gets pretty cool again. So.
Yeah, I'm trying to enjoy it. But, we just had... My 9-year-old just turned 10, and like I said, I think she feels like she's 19 because that's about the same answer I get.
Yeah, she knows.
I know, Dad. I know. Okay, great. You tell me then. Okay.
Let me know how it goes.
Yeah. Oh man,
it's all good. It's all good. I love kids. Don't regret them. Glad they're growing up.
Getting a pay raise.
I'm getting a pay raise because as they keep ticking off 18, they come off the payroll. So
yeah, heck yeah.
All right, wraps up the show for the day. Got any questions or comments, get by the website, realinvestmentadvice.com. Michael Leibowitz laid an article out talking about, is the Fed pivot really going to be helpful for the markets? Also, make sure you're subscribed to the newsletter, our daily market commentary, which comes out every morning at 7:30. Also, make sure while you're there, if you want to go to the long-term care event this Saturday, April the 1st, 8 a.m. Central Time. Subscribe at the website and you'll get a link, and basically just log in Saturday morning and we'll take care of you about long-term care. In the meantime, if you have any questions or comments, hit the website, let us know. Always happy to help you out. Have a great day. See you back here tomorrow.